Welcome to Rogue Trader. Please read the disclaimer and remember that prices can go down as well as up. I'm taking a look at Hikma Pharmaceuticals as a defensive stock. Obviously, people are still ill even in a global catastrophe, so they are a bona fide defensive stock. Now, actually, for generics, there's even, as well as beyond the COVID times, a good long-term bull case for generics. And this is detailed in their latest annual report. It's expected that there will be a 25% boost in generic sales in the medium term, with by 2024 sales of 100 billion globally. It was interesting to see that actually currently 17% of US GDP is spent on healthcare, and the world population is expected to increase to 2 billion by 2050. Now, of course, around the world, people are getting richer too, and there's going to be a lot more older people as well in the general population as birth rates decline. So there is overall a very good bull case for generics, and I think Hikma Pharmaceuticals are then a good defensive stock to choose with great long-term prospects as well. So Hikma are the third largest generic injectable supplier in the US and the number 10 generic supplier overall. They're also the number one supplier to the Middle East and North Africa region. They own the entire process from the research and development through to manufacturing and sales, and develop generics from their own R&D as well as from in-licensing products. So I actually had all of the main UK listed pharma companies in my initial defensive stock filter, and Hikma were the only one that got past my initial scrutiny of their balance sheets. And they've got some really nice numbers actually. Now, Hikma began as a family business. So their executive chairman is Syed Dawaza, and I went onto Wikipedia, and his father actually set up the company in Jordan in 1978, and they started out in the Middle East and North Africa region, and then later expanded into the US. This actually was an initial kind of concern. I don't, because I was thinking, is there like a benevolent dictator kind of situation going on? I looked into it a bit, and I found actually that indeed the family do completely control the company, even though it's publicly listed. They directly, Saeed and family members directly own about 10% of the stock. And then there's a company, Darhold Limited, that owns 25% roughly of the stock. So the family kind of own 34% of the company. This means it's just something to definitely bear in mind. You know, it could mean there could be massive changes all of a sudden. But to be fair to them, I mean, the numbers speak for themselves. I think they have an excellent set of accounts going back a long time. Yeah, so going back quite a long time, I really like their numbers. So kind of the results speak for themselves. I like how they've been managing the company. And then also, actually, a few years ago, they moved to an executive chairman position, and they created a chief executive officer position with this guy, Siggy Olafsson. And they've been making a real big thing in the annual reports that the family are kind of stepping into the background and letting Olaf take control of the company, at least in terms of execution. Their board is very diverse. It's not just all family stooges. It's mostly completely independently brought in people. I think that actually the situation is, although it was a family run company, I think they've got a nice balance right now. I think the results historically definitely speak for themselves. I'm quite kind of comfortable, but you still just have to bear in mind that that one entity owns a third of the whole company. So they started out in the Middle East and North Africa, and then they moved into the US, which now accounts for 2/3 of their revenue. So branded medicines account for about a quarter of their revenue, and then they also sell generics. And then more recently, they've moved more into injectables. Now, their general strategy is to move away from generics a bit and more into complex generics, which have higher barrier of entries. The generics industry is very competitive now. And then injectables, of course, I mean, they are selling generic injectables, but these are very high barrier of entry as well. They're quite very complex products to manufacture. And this strategy seems to be going well. I'll go into that a bit later. But the core operating margin is obviously lowest for generics at 17% and highest in injectables with a very high, seemingly 38%. Now, their general strategy, according to their 2019 annual report, was just to carefully grow from their existing business model with a focus on long-term sustainable growth from good portfolio management and investing in specialized products. So looking at their net income history, and there's a nice widening actually between their income and expenditure over the last 5 years. The only problem was this upset here in 2017. And that really was a one-off event, which was related to this complete 1 billion write-down of their Columbus business. A bit more detail I'll go into later, but a bit of an upset here, but then otherwise generally a good trend. So that obviously then reflected here just in their revenue and operating profit. You can see how it's pretty stable, the differentiation between their revenues in the US, Middle East and North Africa and rest of the world, which is pretty insignificant. And then also there you can see how their generics is kind of flatlining and their branded actually is kind of flatlining, and their growth has been from their injectables over the last 5 years. Now, a company like this with nearly 700 products, it's hard to focus on individual products to try and predict how their future revenue growth is going to pan out. So what I've done is I've looked at their product pipeline and just seen what is it that overall in terms of general numbers are coming in. So to try and assess their future sales, I've looked at their research activity. And for a generics company, all their products have to go through research and development first of all. And then the products are filed with a abbreviated new drug application filing. And then the regulatory authorities will approve most of those, although there's always an attrition rate. And then the company will do product launches. And we see in this graph down here that there was actually a drop in the number of filings and approvals, but it has ticked up in 2019. And I think that this is actually a reflection of their change of strategy, maybe from a more shotgun approach to focusing more on specialized generics, because they want to have those higher barriers of entry against their competition. You can see that the profits of the injectables stays much higher than from their generics and branded, but you can see actually a step up in the profits from the generics and the profit margin then. And I'm not sure if that was related to buying all of those Roxanne Lab, also known as the Columbus business, and then shutting it all down and keeping some of the product lines, or if that was just more a refocus on more specialized products that's caused this. But certainly when I look into their research and development pipeline, we can see that it's actually doubled. The number of filings have doubled from 2018 to 2019, and also a tick up in product approvals. So although it's down from 2015, there seems to be a nice positive trend. So overall, from looking into this, I'm fairly comfortable that they certainly won't be going backwards as long as their strategy works of focusing on more specialist pharma. And then I listened into some of their more recent investor calls, and there you can see the breakdown for injectables. In 2019, it was up 7%, let's say flat really. However, in their 2020 interim call, there was actually a boost in the injectables business of 13% core revenue and 22% core operating profit. And this, they say, is because, as well as some new product launches, was boosted by the COVID situation. There was a lot of demand for some of their COVID products. So, that's some good news for Hikma. And then for generics, they were actually, in 2019, profit up by a third, core revenue kind of flatlining. And then in the interim, it was pretty much stable. And then for branded medicines, an 8 to 10% increase in core revenue and operating profit. And then in the interims, up 14% core revenue and 6% operating profit. This more kind of short-term indicator, it's looking good and actually boosted by the COVID situation. And then in this more medium-term indicator, it certainly doesn't look bad. It certainly looks reasonable. So looking at the 5-year timeline, and we can see that their share price sank quite a lot. And this seems correlated with this acquisition of Roxanne Labs, and also actually probably failure of the Advair Discus ANDA as well. But there was a severe decline for a couple of years. But then that's been reversing, and they've been uptrend since 2018. So yeah, the last 2 years, a really good uptrend versus the FTSE. So this acquisition of Roxanne Labs, who are also known as the Columbus business, this is what caused this severe case of indigestion in their books. And I've been looking into this, and according to their 2017 annual report, this was a clear cock-up. So, a mistake really in the management. They actually say in the annual report, we had to reevaluate the potential of the Westward Columbus project portfolio and R&D pipeline, which we now believe to deliver less than we anticipated at the time of the acquisition. As a result, we are taking an impairment charge of 1 billion. So that looks really bad. On the other hand, it was just interesting here looking at their margins drop with the takeover and then get boosted again after the restructuring. And it kind of left me wondering, you see the revenues keep going. Was this just a total mistake to buy this business, or was it kind of some kind of asset stripping exercise and was actually like a shrewd move? And that's not really, I can't help but kind of speculate that, but I don't really know the answer. But still, this was kind of a big news item fed in from that acquisition, and at least we kind of now understand what happened here with the numbers. And then another big news item has been this Advair Discus. It's like an inhalation product, and they've also through time they've got deals with Vectura for salmeterol, and then here when we go forward, they've got a deal with Vectura to develop Ellipta generics. They want to move into inhalation because this is obviously a specialized generic medicine format which has a higher barrier of entry. This then should be their flagship product, this Advair Discus. And unfortunately, they did a filing, it got rejected. They then had to do an 18-month clinical study a massive, really expensive study. And then coming up to 2019, they completed the study, but then this year it got rejected. However, they say only with minor responses from the authorities, and they say that they've fixed that with some new work and data they've submitted. But still, it seemed to me it doesn't inspire confidence, their failure to, and over a long period of time. So I look at that as kind of a minor danger. I mean, I looked into it, and actually it would be only a 5% hit to their 2020 revenues if not successful. But still, that's a news item that could, I think, damage them. Then in 2018, they hired a new CEO, and then they have a chief transformation officer, and then a new chief scientific officer. You can see how they're moving away, or the family are shrinking back into the background a bit more, and they are more running like the corporate governance of a FTSE 100 company. And like I said before, I think I'm generally happy with what I've seen over the last 5 years. So, I think their general management is good. Into 2020, an important news item was this Eurobond issue. So they had currently a 0.5 billion euro bond that was maturing. So they issued another one, which is all fine already. And previously, Boehringer Ingelheim had 16.5% of the total shares of the company. They sold all of them, and Hikma bought back 5% of that total of the shares in the company. So I think that was a positive bit of news, really. And then finally, a very interesting bit of news was that Hikma were selected by Gilead to manufacture their remdesivir products, which is used in treating COVID. Actually, remdesivir was used to treat President Trump when he was dramatically being treated for COVID in that hospital for a short time. And so, although Hikma are only the CMO rather than the actual owner of the IP, I still think that's great news that they're being selected to make this important COVID drug. So they pay pretty decent dividends. It's around 2%, say now, and historically they've always paid reasonable dividends. So looking at their numbers, and they had a really good profile, especially compared with the other stocks in the FTSE that are pharmaceuticals. You can see their revenue nicely trending upwards, and in terms of their expenditure, they keep that well under control. Their R&D well under control, their general admin well under control. The only hiccup was this disposal of this Columbus business, which I've gone into already. But you can see here that generally there's a nice widening of the gap between income and expenditure, and a nice gradual increase in their net income once you take out this the digestion of this Columbus business. Then their assets, I mean, it was all very straightforward, so there wasn't really anything for me to highlight other than, look, they've got 0.4 billion in cash. But really, the assets just trending up slightly, but nothing really that I really wanted to look into. The only thing interesting was in their debt, which was where they had this €500 million euro bond, which then went over into short-term debt in 2019 because it was going to mature. And then, of course, they paid that back with a new euro bond they got issued just in 2020 that pays 3% interest. And the other thing that happened was they spent 296 million to buy back 5% of the total float of the company. So that explains the long-term debt here, but it's generally in line with historical numbers. They have a 1 billion revolving credit facility, which they haven't really dipped into much. And so, they do have some debt, but it's pretty, pretty simply operated. They just have corporate euro bond. They just have euro bonds that they issue, and always have done. But it's generally, compared with the AstraZeneca and GSK, who are just fiendishly complex, I find for a pharma company their debt situation to be pretty minimal and very reasonable. I'm very pleased with their net asset value, which is actually kind of doubled over the last 5 years. And then looking at their equity, and again, very plain and simple, just how I like it. Most of their equity is in the form of retained earnings, and it's all pretty nice. So Joe Biden looks like he will win the election, and so I had to consider what would the effect of that be on Hikma. And generally, there's a detail here. I won't go into it too much, but the general thing is Trump would have been great for like individuals who wanted to buy medicine in the US, and great for the US workers, but basically bad for the pharma industry. Joe Biden's going to basically expand the Affordable Care Act, which was kind of this Medicare thing. And really, it's just going to be great for the pharma industry. There's not really going to be so much protection from foreign manufacturers, but there'll be a big boost in spending, in particular in generics, because there'll be lots more poorer people being treated, presumably with generics. I think the Joe Biden election is only going to be good for the pharma industry, in particular generics. So to summarize, Hikma are definitely a very good defensive stock, and I think they'll be good to hold in the long term as the generic bull case plays out, particularly with recent developments in the US. So my entries, I want to have them in my short list, and when I decide I next want to invest in equities, they're in my short. If I buy them, then they've got solid books, and I'd want to check that their financials maintain this record as long as I hold them. I'd exit them if their business model doesn't pan out. They start failing with all these complex generics they're trying to develop. Their financial performance shows that their management team isn't working anymore. But I think they're relatively low risk of that, looking at their past performance. Other risks are the failure to deliver on their KPI targets for profit margin and new products. There could be a sudden takeover or merger or family selling the company. Kind of low level risk-ish, but keep an eye out for that if I'm holding them. If there was some kind of major quality scandal, and this is the same for any pharma company you buy, but you can look out if there's an increase in minor risks and stuff, and sort of strange news stories, then that could be a predictor. And then also, if there was any major disruption in Jordan or Saudi Arabia, that would affect this company. In terms of valuation, I got this tear sheet which you can get from the London Stock Exchange website. In terms of price to earnings, Hikma are looking pretty cheap. In terms of enterprise value to EBITDA, again, pretty cheap against the other pharma stocks. Their price to book, pretty cheap. Their price to cash flow, again, pretty cheap. And their price to sales, pretty cheap against the other pharma companies. So using this tool available on the London Stock Exchange website to try and get some kind of valuation estimates, Hikma certainly look very reasonable against the other pharma companies listed on the FTSE. So I think that Hikma are definitely a very promising defensive stock, particularly in the current situation. And I've added them to my shortlist as a very strong contender if I do decide to buy another stock before the end of the year. I plan to do a bit of a macro overview, and then I probably am going to buy one other stock. And Hikma are definitely a very strong contender. I'm just going to do a couple of quick updates on Cranswick and Gamesys first before I make that final decision.